It is called the Global Corporate Minimum Tax, and the United States should not be part of the compact. Jonathan Williams from the American Legislative Exchange Council explains why on this American Radio Journal commentary.
The Treasury Department recently announced that it negotiated a delay to the imposition by foreign nations of the global corporate minimum tax. In 2021, the U.S. and 140 other countries signed on to an agreement under the Organization for Economic Cooperation and Development, or the OECD, that would implement a 15% minimum global corporate income tax in all partner nations. The deal had been cited by proponents such as our own President Joe Biden and Treasury Secretary Janet Yellen as an attempt to curb international corporate tax avoidance. However, the OECD Global Minimum Tax Agreement has several major negative policy implications that are being outright ignored in this discussion, including a decrease in economic competitiveness and tax competition, let alone the circumvention of the separation of powers laid out by the United States Constitution. Much of the argument for the global income tax is based on the premise that businesses need to pay their fair share. But proponents are forgetting the most important lesson when it comes to business taxes. Businesses don't pay taxes, people pay taxes. As former U.S. Senator Phil Gramm of Texas wrote in the Wall Street Journal earlier this year, quote, President Biden wants to make the world safer for tax increases, unquote. While some countries like Japan, South Korea, and those in the European Union have implemented the global minimum tax already, the United States wisely has not. Attempts to make those changes here have received bipartisan pushback in Congress, since American companies would be a major target in this global tax price-fixing scheme. Notably, U.S. Ways and Means Committee Chairman Jason Smith, an ALEC alumnus, has led the charge to oppose such an effort. The Biden administration is essentially holding Congress hostage by agreeing to allow foreign governments to collect taxes on American companies or their subsidiaries if the U.S. laws do not come into compliance with the deal. Sadly, it plays out for U.S. companies, and it looks like a case of heads you lose, tails you also lose. So what's the upside for the United States as the Biden administration attempts to unilaterally surrender U.S. sovereignty over its business tax policy? Well, that's a very good question, because a recent report from the Joint Committee on Taxation said that under one scenario, the United States would actually lose $122 billion in revenue as part of this deal. Beyond the major consequences for the United States, the ramifications of this global minimum tax deal could be disastrous for all countries that use pro-growth tax policy to expand their economies. Competitive tax rates encourage nations to craft smart policies or else lose out on the job creation and economic opportunity. The world can learn a lot about economic competitiveness by examining the dynamic of the 50 states in our system of competitive federalism. Letting the states establish their own tax rates and fiscal policy means that state leaders can determine what's best for their state economies. In many cases, competition with the other states forces leaders to implement policies to increase their economic competitiveness and growth. If the price to live, work, or start a business in one state becomes excessive through the costs of taxes and regulations, for instance, Americans can and often do vote with their feet in search of more economic opportunity. We see this in states across the country as Americans continue to vote with their feet away from high-tax states like New York and California and towards low-tax, freedom-loving states like Texas and Florida. Much like New York and California, we've witnessed the failure of burdensome, centralized tax structures on the international stage in the EU, where the average resident is poorer than the average resident of nearly every state in the United States. The Wall Street Journal recently reported that the Eurozone economy, with its high tax burdens and overregulation, grew only 7% over the last 15 years. Compare that with the 82% growth here in the United States. This is a tragic international example of how stifling economic competition turns out to be damaging for economic opportunity and growth. A global minimum tax regime prevents the very competition that has produced these great results through competitive federalism here in the United States. Just as the 50 states can and have competed on tax policy, so too should nations be striving to build better tax structures to build their economies through tax competition, not global command and control tax harmonization schemes. For more information, go to alec.org. For American Radio Journal, I'm Jonathan Williams. Thanks for listening.